Hey everybody, welcome to Retire with Style. We got the three amigos here, or two amigos and one acquaintance.
Wait, I'm sorry. Apparently you've been downgraded.
Downgraded.
No, it's actually myself. I'm having trouble.
Okay.
Yeah. I didn't read my affirmations today, so I'm just a passing acquaintance with myself today.
Yeah.
Alex, we got Bobby French. I don't think I've ever referred to him as Bobby, by the way. And Wade Fowl. How are we doing today, gents?
Doing great.
Come on, Wade. We need a little more enthusiasm. How are we doing today, gents?
I am pumped to talk about performance of managers.
That's as good as it gets. And that's why we love them. Bob, how you doing?
I'm doing well. All
right.
I actually am pumped to be talking about manager performance. This is a fun topic. So
Are you as pumped as a certain bear?
I don't know that I've ever been quite that pumped.
And this isn't an investment bear.
No, this is not.
We were speaking, we were having a little chit chat before the podcast, a little change of pace, but the story was too good. And Wade said, hold it. That's gold. We need to put this in the intro.
That's right.
Wait, do you think anyone believes me, by the way?
So let's cut that silence short. What Alex is talking about is so I think it was last time might have been the time before we were talking about how I've never seen Godfather. Wait, I don't believe you saw Godfather either.
No, he has.
I've seen the
He
first
has.
one.
Oh, excuse me. So I'm the odd one out. But my taste is more towards this weekend. My wife and I went to go see Cocaine Bear, and I will say it is exactly as awesome as you think it is, for good or bad. You know exactly what it's about. But yeah, it was a lot of fun. So.
And what happened? What's it about? Is it like snakes on a plane, but with bears?
It's it's a very sedate kind of nature documentary.
It's based on a true story, I heard.
It's based on a true story.
Yeah,
it was
about Waylon Jennings.
That's right. Yeah, the real life bear didn't go around killing people. I guess fortunately, but they did find the bear after it had OD'd on cocaine, and then they stuffed the bear. And for a long time, it was hanging out in a mall in, I think it was Kentucky, just kind of chilling.
Of course.
Yeah. And then Waylon Jennings owned it for a while.
Which is very appropriate, by the way, that Waylon Jennings would own the bear.
Yeah, there's a group of people who, if they knew that a bear who OD'd on cocaine was stuffed sitting in a mall somewhere, they're definitely going to buy that. And
if that doesn't say outlaw country, nothing does.
Yeah,
now,
I don't know if he still owns it. I don't know where it is now, but yeah.
Now, a little unknown fact about Wade. You're talking about Cocaine Bear. You saw Cocaine Bear. Wade, Bobby's thinking where I'm going with this.
Where is this going?
That's the best
Nowhere
part.
good this is going.
He can recite Cheech and Chong's Up in Smoke from first scene to the last. No, not at all. And Wade may say at the end, I think we should edit that.
Honestly, I would have believed that one, actually.
No, I just think it's funny.
It's not implausible.
Ah, here we go. Shot over the bow. No. So what are we talking about? What else are we going to laugh at today?
Yeah, so today, we've kind of been talking a lot about kind of the different styles of kind of market analysis that are out there. So we talked about technical analysis, the one with all the weird charts, fundamental analysis, the one with all the weird spreadsheets, and then market timing, which is kind of the lazy way of doing it, if you will, kind of the everyone knows type of thing.
I disagree. Technical analysis is probably the lazy way. Fundamental is kind of maybe a little over the top, and market timing is in between that.
There you go. Okay. We can go with that taxonomy there.
What were you saying? But wait, what were you saying?
Compromise.
That's
Yeah,
right.
exactly.
Both, right?
Exactly.
Because there's no clear framework.
Yeah, exactly. But today, what we wanted to kind of take a look at was, the professional managers out there. What are they doing? They're making a lot of money doing this type of stuff. So you would think that they must be doing something. People are very clearly very happy to pay for them to do these sorts of things. So does it make sense? Are they actually providing real value to their investors, the people putting their money with them?
Can I ask you something? Because this has to do with this, and I think it sets us up as well from a contextual standpoint. I didn't like my formal education was not in this field.
Mm-hmm.
All right. Bob had a foggy 4 years, so I don't know if he can answer this. No, his thing was, he was in this field, but just all his life, really. And Wade, you were in this, PhD in economics, so there was always this sense of it. I think for the uninitiated, if you will, I think it's fairly logical to think there's an entire educational system geared towards, developing fine young people to be able to bestow on them these analytical skill sets to be able to do such and such, right?
Yeah, to the point that Wade and I actually have that credential.
But it's fairly reasonable for a consumer to think, they listen to our technical analysis, they listen to our fundamental analysis podcast, they listen to our market timing podcast, and even after all of that, they can still think, yeah, but guys, there's professionals that get paid $1 million+ to do this, and you can't tell me the king has no clothes kind of story time. It just can't be. There has to be this value that's being added. That's where if I'm listening to this, I'm thinking that, come on, guys, really?
Yep. No, entirely. I mean, it's baffling that, we can go through and say, oh, all these approaches don't work. But the financial service industry is still, by and large, entirely devoted to doing this, at least on the investment side.
So is it possible that my degree in film was more useful than if I were to have had a degree in, I don't know, fundamental analysis for stock picking? Because at least I enjoyed watching movies during those 4 years.
True. Yeah.
Is that a fair statement, Bob?
Well, going back to what we were saying about fundamental analysis, who are you providing that value to?
Oh.
It doesn't seem to be, and, we'll talk about this as we get into it, but, one of the nice things about looking at kind of fund managers, in the public space, so mutual fund managers, is we have really good data. Because of all of these reporting requirements, we can actually go in and see, okay, here were the returns on all of the funds that were available. And we can see what actually worked, what didn't. How did these people actually do? And, the results not looking so hot.
Yeah, this goes back to the phrase that I like my stats professor kind of phrase says, "God, do we trust everyone else bring data?" Or is it datum or data in this case?
I think you'd want the plural, so data.
Yeah.
I know. I just like the mess with data.
This is an important point, though, because
no, absolutely.
I've had a number of Uber drivers over the years who talk about how great of investors they are, and there's no way to really verify their past performance, but we can do that with professional fund managers, and that's an important part of today's show.
And I want you to think of this like in other professions. Try to make analogies in your head. Imagine if we had data on successful surgeries, successful knee replacement surgeries, right? That would be a good barometer of an orthopedic surgeon, right? Who specializes in knees, etc. Right? That would be the same criteria you would say. You would ask for. Well, how many, what's your hit rate on these things? Take it away, Bob.
Yeah, it's not good. The hit rate is not good. But and we can come at this any number of ways. There's been a lot of academic papers looking at this. We can look at case studies. We can look at just the raw data in and of itself. But however you cut this apart, active managers don't seem to be adding value. And taking a look at this, I mentioned the academic papers. This has been kind of one of those staple papers that, every year, every couple of years, there's a new one coming out with, some new piece of analysis, basically slicing the data in a slightly different way, saying, yeah, active management doesn't work.
It's funny when I got into the industry, this is '01, right? And so this is already known information. But among advisors, it's in the institutions, it's in the academic papers. But advisors, at least back then, it was more of a licensing kind of profession as opposed to, you get a degree for, which is it's like that now, right? Mm-hmm. And so there wasn't. I don't think there was a lot of awareness, at least across the most common denominator advisors, if you will, about this. And, when you start looking at the Journal of Financial Planning and stuff like that, like the articles that were getting published were, hey, the failure of active management, these kind of things were coming up. It's almost to the point now that I would say if you were to do do a little dissertation proposal, or if we were to write a paper and submit it to the Journal of Financial Planning, if you will, showing how, hey, the last 10 years, active managers didn't beat an index, that wouldn't be published because it's like saying that it rains and you get wet kind of thing. And a dissertation professor would say, no, you got to do something new. You got to contribute something new to the literature. This has been, this has been done too many times. Yeah. And the other piece I would say in terms of how this goes over and over, when I got into this, I used to, I would do client presentations and I would update these numbers on a monthly basis. And then after a while, you're like, quarterly is good enough because the story's the same. And then after a while, yearly is fine because it's still the same. And you do it just because folks are listening to it for the first time. So they want to know, okay, but what about now? That kind of thing. But it's just such a reoccurring theme over and over and over that even in preparation for this podcast, Bob and I were talking about, hey, should we get updated numbers? And we look at each other and we're like, we can, but it's the same thing over and over again in terms of the outcome. And there's reasons for that we'll get into. Yeah.
But as you start looking at this, there's any number. My father's actually written one. He found that, was it through 2008, I think it was, active managers basically subtracted 0.2% from their investors' total returns per year. But one of the things that you find when you start running the numbers is that, basically active managers get the returns they're supposed to based on the risk that they take within their portfolio. They're not adding alpha. Their returns are very, very well explained by the risks overall, absent the costs.
I think this is a very good point. Because one of the misconceptions, and it's very easy to see this, and this will be our, start of our CNBC reference. You get somebody speaking, right, and they'll put in this person has beaten the S&P for the last 5 years. You're like, oh wow, okay, this guy or woman knows what they're talking about. Let me listen. And Bob's dad, Ken French, what he pointed out, it's not just beating the index, but it's beating the index or beating a combination of indices, if you will, relative to the risk you took. Mm-hmm. That's what's important, relative to the risk you took, because you can structure a portfolio in which you're passively capturing those risks anyways. There's no like advisor alpha, and we're going to use advisor alpha or investor alpha as a term to indicate that they can provide above average market returns, right? But that phrase, relative to the risk you're taking, is super, super important. And that gets just obliterated when the newspapers are writing articles or whatnot. It's bad enough that people usually don't beat the S&P, but if they do, when you take into account the amount of risk they took, it's very suboptimal on a variety of levels, and that's kind of a level setting theme that you kind of want to put out there. Would you agree with that, Bob?
Yeah, absolutely. I mean, if we're just looking at it in terms of raw numbers, for the past decade, anyone who's been a growth investor has looked like a genius because growth is done phenomenally well up until relatively recently. But if you break it down and look at it relative to the risks, what they're actually putting in their portfolio, they get kind of what you would expect because they're a growth portfolio. And it's as simple as basically effective benchmarking.
Yeah, and what Bob is saying is, okay, you're a growth portfolio. You have growth stocks, right? Well, you don't compare yourself to the S&P. The S&P doesn't present itself as having those growthy risks. You compare yourself to the S&P 500 growth index or something like that, where they're doing it across that stable. It wouldn't be the S&P 500 growth index. It would just be the S&P growth index, whatever. And so those are similar risks. I mean, I remember in the dot-com boom, I mean, a top 10, it was like in the top percentiles. I don't remember because it's off the top of my head, but the QQQs, which was effectively the NASDAQ index, if you would have invested in the NASDAQ index as opposed to, I'm going to buy Cisco, I'm going to buy Dell, I'm going to buy, at that time, Sun Microsystems, I'm going to buy Microsoft, I'm going to buy, those kind of things. If you would have just bought the index, the QQQs, you would have outperformed. It's like something like 90+% of everyone else. So think about that. It's not just outperforming. It's outperforming relative to the risk you took. And those risks manifest themselves across different benchmarks / indices. That's important because you can passively capture that.
Exactly.
You don't need some sort of newly minted MBA to do that. No, you don't, right? Or some retread kind of thing. It's just you can passively capture that.
Exactly.
And the benchmarking part.
Sorry, Wade, go ahead.
Well, I mean, the benchmarking part's important too because it's not always just the risk, but if international outperforms U.S. markets for an extended period, anyone who's running a fund that may benchmark to the S&P 500 but is allowed to allocate internationally as well has a pretty good chance of outperforming the S&P 500. And then by those sorts of metrics ends up looking like they're a superior investor when it was really just a matter of they're allocating to an asset class that was outperforming during that period.
100%.
And, that even brings up another issue as well, style drift or just style allocation. When you're building a portfolio, you're generally looking for funds that will fulfill specific mandates. If I'm looking for a U.S. large cap fund, if I'm looking for something to track the S&P 500, but it can go out and buy, other non-U.S. large cap companies, it's no longer doing what I wanted in my portfolio to be doing. So.
Yeah, and there's even one, before we even get into the really rolling up the sleeves part, there's one thing. I don't know how you folks feel about this, Bob and Wade, but I'll give in on this count. Is there some special, unique individual that's like 10 standard deviations away and was born to be an investor? Could that possibly exist? Yeah. I'm willing to say, yeah, sure. Even though we went over the fundamental stuff, even though we went over the technical stuff, even though we went over the market timing, maybe somebody was touched by God, and there you go. But I say that in the sense of Shakespeare, Mozart, Michael Jordan, maybe it's Jim Simons over at Renaissance Technologies. Maybe he's the one. But the point is, these are once in multiple generation type of talents.
Yep.
This isn't like some guy went up on Wall Street and, whatever, went to Princeton, got his doctorate in economics, and off he goes. Those aren't it. These are these just unique individuals. Those guys aren't listening to this podcast. Those people aren't listening to anyone, frankly. They're just, doing it.
Yeah.
Bob, would you concur with that statement, or?
Yeah, no, and we have seen At least one person like that. Not particularly recently, but
Fido? Is it Fido?
sorry about that. We can
No,
cut
it's
this.
fine.
But we have seen someone like that. I mean, we have seen Peter Lynch. Back in the 80s, he is undeniably someone who is either so far and above the luckiest person to have ever existed. If all of his stuff was if all of his outperformance was by random chance, or he could legitimately do it, and be observed to be doing it relatively quickly, which is also a really, really important point. It doesn't matter if you can identify them after the fact. You need to be able to identify them while you can still get in and have them continue investing.
But what you mean by that, though, and just because to determine if someone's outperforming by skill versus chance, you need a long sample size to be able to, determine the signal.
Performance.
Yeah, you need, exactly. For you to determine the signal from the noise. And what Bob's getting at, but when that time does come along, he's probably retiring or she's probably retiring because, they just don't need the aggravation.
So the interesting thing here, though, is Peter Lynch. I wrote an article on him a few years back now, and I forget exactly how long it takes to identify that he was truly outperforming, but it was on the order of like 3 or 4 years into his career after he took over his fund, the Magellan Fund. So it was very quick to identify.
It is quick. It's usually like 15.
Yeah, he was good.
Range.
He was adding like close to 1% of alpha per month type of numbers.
Wow.
So he could do it. But the interesting thing about Peter Lynch is that when he went to retire, he was able to quite obviously pick his successor, pick who was going to take over the Magellan Fund. So if you think about it, he had effectively the same problem as you or I if we were to go out and try and pick an active manager, trying to pick someone to beat the market. The difference is Peter Lynch, he had access to effectively any piece of information that he could possibly want about someone. There's a decent chance they were working for him. So he could observe, hey, does this guy come in early? Does he leave late? It was the 80s. Well, I guess it was the early 90s. So it was still he, unfortunately. Does this person, how do they make their decisions? What are the decisions that they have made? How did they work out? What are the decisions they decided to hold back on? What are the stocks they didn't like? How did that happen? What are they like running a team? What's their home life like? Are they about to get divorced? Are their kids doing poorly in school? Are they going to get distracted? All of these pieces of information. And, he took all this in. He was clearly, like I said, someone who knows how to do this. So theoretically, he probably would be able to pick someone better than you or I. And, well, the first person he picked only lasted about 2 years before he left. But, presumably he was very involved in picking that second person as well. And those two people were average. And for an active manager, that's actually not a bad thing. They didn't subtract any value. When you look at their risk-adjusted returns, they basically got what they should. So if Peter Lynch can't do it, if Peter Lynch, who, again, is probably one of, if not the best investors ever, can't figure out who else can beat the markets, that's a pretty tough order for us.
No, and to bring in another field, because this is what I mean by you're talking about generational talent, if there was such a thing, right? Look at Bill Russell. Arguably one of the best top 3, whatever, basketball player ever. They won while he was coaching the Celtics, player coach, but when he was no longer playing, goes to the Supersonics, I believe, and also the Kings. Yeah. He could pick whoever he wants. Right? Nothing. Same thing with, I mentioned it in a previous podcast, Michael Jordan.
All of these.
Terrible GM.
Yep.
That kind of thing. And that's when you have access to, hey, I'm going to identify the traits that I had and I'm gonna, identify who else similarly has that. If Michael Jordan wrote a book, hey, how to play basketball, and I gave it to my son, well, no, I'm too small. Let's say Bob gives it to his son, right? Now, he's got a chance. Bob understands that this will have no effect on your son's ability to all of a sudden flip a switch and play basketball, or your daughter's ability to all of a sudden flip a switch and play basketball. You don't want to think that, right? But for some reason, Peter Lynch writes a book, and you know what? Let's open that account. I'm ready.
Yep.
It's just you have to give it its respect, and you don't see that. You just don't see the numbers over and over again.
Yeah, it's very clear from the data that there are people out there who can beat the market very, very occasionally. They exist, and I'm even willing to believe that it's more prevalent in the private markets, like hedge funds or private equity. The problem is we have no way of observing that, and even if we could, they probably wouldn't want our money. For people like that, people who clearly can add some value, getting access to money is not the problem. It's the investment ideas. So in the, hedge fund space or the VC space or any of those types of places, there are VCs who are better than other VCs. If you're a startup company, there are certain venture capitalists that you actively would prefer to be working with. Those people are the ones who aren't accepting new investors.
Yeah, I mean, you have to, and we can talk about general numbers, but I think everyone who's probably listening to this understands most active managers underperform the benchmark, yep. And we can go over returns, but and we'll get to it in a second. But Bob's point is very important. The phrase that he's pointing out is the economies of rent go to the scarce resource. Wait, how do you like that? I wasn't even an economics guy at all. The economies of rent go to the scarce resources, which is like the extra returns don't go to something that's available. They go to the unique talent. And so if I am, I'm somebody that can find above average market returns consistently, I'm not going to do it in a long only mutual fund. That's pedestrian. I'm going to open up a hedge fund, right? But I'm not going to charge, if I know that I can outperform 2% a year, the market, whatever that number is, I'm not going to charge you 50 basis points or 0.5% a year. Because then all of a sudden, my acumen in being able to determine stocks and what's going to happen, for whatever reason, I don't use that same mindset in my expenses of my business. If I know I can outperform by 2%, I'm going to charge you 1.99, effectively, because I am going to take those economies of rent for myself. I am going to take that extra, surplus for myself. Why? Because I can. That would be the thinking of such a person. And that's very, very important. Somebody that can outperform 10%, the market by 10% a year, is not going to charge you 1%. They're going to charge you 9.99%, whatever that number is. Mm-hmm. And so when you add that VIG, good luck. No, it's the truth, right? I mean,
yes, absolutely.
That's what Bob was getting at by that. The economies of rent go to the scarce resource. They don't all of a sudden become munificent and want to give it to you.
Yep.
Wait, did you see what I did there? That was the what?
That was the SAT word of the week.
Yeah, word of the week.
So, I mean, there is one other interesting aspect in there as well, in that public versus private market divide. In the public market, we have effectively near perfect information. In the private market, we very emphatically do not have that level of information. So it's probably easier to beat the market, whatever market means in that context, in the private markets. There are, like I said, there are some people who are just legitimately better for whatever reason in that space. It's just much, much more difficult to identify those people.
And Bob, I'd rather, if you don't mind, I'm going to call an audible here. And
Yeah, please.
this could be another podcast in and of itself, because here we're talking about mutual funds and stocks, and I even got into it. But there are a lot of factors at play in determining returns within hedge funds and private equity. And while we're willing to say, yeah, there could be some sort of polymath out there, I'm not willing to say that that's where the smart money really invests and you can outperform, because there's a lot of issues involved with just pricing transparency, et cetera, that you'll find that you don't really do all that better. But that's for another time. Here, let's just, maybe reel ourselves back.
Shift outside of that rabbit hole we were or at least I was driving.
We can do that, but let's just hold back on that right now.
Yeah. But, I think a good place to start here was, we've been talking about this. We've known active managers underperform for an incredibly long period of time, to the point that, Bill Sharp back in '66, this was one of his first kind of big findings. He did a survey of manager performance, and they were all active managers back at that point in time, but he did a survey of manager performance. And, he found that managers underperformed the market as a whole. If you were to just go out and invest in the market, you would have done better than, I don't know the percentage, but the vast majority of investment managers did at that point in time. We've known that since effectively the birth of modern finance back in the 60s. And, as we've said, that finding has kind of been one of the staples of academic research since that point.
And Bob, can you make the distinction there between gross of fees and net of fees? So the average active manager gross of fees should about half of them do better than the market, half do worse. But when you add in the fee drag to that, that's when you start to see that most is in whatever that most means, 70, 80, 90% of the active managers are not outperforming the benchmark or the overall market index.
Absolutely.
And Wade, why, if I were to respond to you, yeah, but that study was done in the 60s. We're in a stock pickers market now, right? Where it's a stock pickers market, that kind of thing. Why, and I'm referring to the arithmetic of active management. Why is there kind of no need theoretically to redo the study every year? Why did I get tired of viewing this every month? Because the results didn't really change. Why would that be?
Well, if you look at the aggregate, not everyone can outperform the market. There's two sides of every transaction. So the person who wins in the transaction, there's a opposite person that lost in the transaction. So you can't have gross of fees, not including any fees. You can't have more than half of people outperforming the market. Net of fees, that's where not a whole lot of people are able to outperform the market for the end consumer.
Yeah, no, once you get net of fees, it starts dropping down a lot further than half of people underperforming, just mathematically. Another way of phrasing that is if you think of the market as a whole, there's really two sets of investors. There's active investors and there's passive investors. And at least to a first order approximation, passive investors are going to look like the market, which means that group of active investors also has to look like the market. And the market can't beat itself. The market is going to look like the market, just definitionally. So active managers as a whole can't beat the market.
Okay, so then the question I have is, all right, but half can, and it's not really half, it's like maybe 30% or something like that in any given time period, right? Half can, but let's just say for argument's sake, half can. The fact that I'm saying half can is like you should start thinking coin flip at this point, right? And remember what we were talking about in terms of an orthopedic performing an operation. Hey, half of these procedures are going to work, half won't. At that point, you're not doing it. You're really not doing it. So think about how our thinking, to some extent, in some areas of our lives, we have these sort of hurdles we need to cross, which is it has to kind of work more than chance. But in investments, we kind of have this suspension of reality. It's kind of like you're watching the Avengers. And, you're like, okay, there's a spaceship flying and an alien came in, and you just go with it, right? But in reality, that's not plausible. For whatever reason, we don't flip that on when we look at investments. We want to believe in the dream, if you will. But that being the case, okay, Bob, put me in the, let's say, 70% underperform, 30% outperform. Give me the 30%. Absent of the previous 5 minutes in which you said we can't identify the best one, et cetera, et cetera. Right. But, somebody says, hey, I want the 30%. Come on, man.
Absolutely. And, no one invests with someone they think is the average active investor. You're going to go out and pick, the good one. She's really, really good at this, so I'm going to invest with her. He's really, really bad, so I'm not going to do that. You don't just pick a random investor. You don't just pick a random fund. You pick the one you think is going to beat the market. Now, one of the big things that I think is really important to look at are things called persistence studies. So what these are studies where they identify, in an initial period, here are the stocks that won. Here are the, in each asset class, in each category, here's the top 25 stock or 25% of funds in this category. And then over the next period, in the subsequent period, how did they do? How many of them were still in that top quartile of funds in their category? How many of them still beat their benchmark, whatever kind of category you're looking at? And, see if there's real skill. If there's real skill here, you would expect that winners would repeat. That if you beat the market in one period, you would at least have a better than average chance of doing it again. Not everyone. Sometimes, even when there is skill, sometimes people just get lucky. In basketball, sometimes people just get a hot hand every once in a while and they have a really, really great season. And then they come back down. But overall, you would expect this group of people who won would win on average again. That's not what we see in the data. Using that, top quartile in equity funds.
Top quartile, top 25%.
Top 25% in their category. If we're looking at, 5-year windows, so if we're going to say we want our subsequent period, I'm looking at data that ends in 2021. So our subsequent period is 2017 to 2021. The initial period would be 2016 through, I believe, is 2011. So 2011 through 2016, those funds that were in the top quartile, in the top 25% of their category, they had on average a 24% chance of being in the top quartile again, being in that top 25% again.
Which actually, that kind of makes sense.
Not kind of makes sense. That literally exactly makes sense.
Well,
it's random.
Maybe I'm off by 1% or something like that. Go on, Wade.
If it was completely random, you would expect 25% of the group to be in that top quartile again.
Yeah. So this is kind of what's happening here. And just to say it without the numbers is we're looking at people that performed over 5-year periods and they were in the top 25%. Then we look at them in the subsequent 5-year period. And you could do this going back to 1970s and it's the same thing.
Yeah.
And you look at them in the subsequent 5-year periods, what happened? And they consistently regress back towards the mean. And so there's a lot of reasons for that. And, some funds could just go out of business too. And that's why maybe it's a little less than 25%. But there's a lot of reasons for this. So another way to think about this really is there are 8,000 mutual funds, right? And so you put them in a stadium. You ask them to flip a coin. If it's heads, you stay in the stadium. If it's tails, you get out of the stadium. It doesn't quite work like this, but let's say after the first year, after one flip, the 8,000 goes to 4,000. Then the second time, it goes to 2,000. Then 1,000. Then 500. Then 250. Okay? So you started with 8,000. After 5 flips, it's not going to work exactly like this, but after 5 flips, you're at 250. That's what you would expect, right? 50% chance, boom, boom, boom.
And on this example, to be clear, they're predicting the coin flip. So now you have 250 people who have some sort of skill at guessing what that coin
flip is. Thank you. So no one here looks at those people. No one listening to this looks at those 250 people and think, those are great coin flippers. Oh my goodness. No one thinks if you put those coin flippers back in the group of 8,000 and repeat this 5,000, repeat this thing 5 more times, that those 250 people are going to be the same ones after 5 more times. That's the pattern that you see here. But for whatever reason, when it comes to investing, think about it. CNBC, right? I don't know how many, but it's 200 and something work days in the year, right? You can put one of these coin flippers on every day. You can put one of them on every day. And as a person watching, you're going to think, wow, there must be skills because look at this guy. They're finding them like pretty handily. Every day I'm seeing one person that's beaten the market over the last 5 years. So I'm going to listen to this person. And that person's going to give you some chance. It's not the fact that there's 250 people that gets me, is that there should be more of their skill. That's the thing. There should be more than 250 as actual skill. And you listen to them and they give their reasons and you're like, oh, well, okay, 5 years performance, heck, that's pretty good. Sunlight's burning. You got to decide at a certain point, right? But here's another example that you would never listen to this person. If 8,000 people decide, not 8,000, let's just say if 100 people decide to jump off a 3-story balcony, it's fair to say not all of them will die. No, but just follow me. There'll be some group that lives. Maybe they landed on somebody that fell first or whatever. But they're not all going to die. Maybe they'll break their feet or whatever. But they won't all die. Some will survive, right? Just by chance. You're not gonna look at the person that lived and think, I'm gonna jump out of a building the way this person did it. Because look, he lived. Or she lived. You get the joke that this is just pure chance. But we don't make that connection for whatever reason when it comes to this kind of performance style. Those 250 people write books. And all of a sudden, oh, well, it worked for them. Now, I'm going to do this and implement it. It just doesn't work. That's what the persistence studies teach me, that if there was this ability, they would continue. They just don't. And they do so less than what would be predicted by chance.
Absolutely. And, in fact, one of the best predictors, if someone's going to stick around in that top quartile, is cost. Because one of the really interesting things you find is that, we were talking about numbers on the stock side, on the equity side. If you look at the bond side, well, that average goes all the way up to like 30% of the initial winners won in the subsequent period. And when you start breaking it down, it's because on the fixed income side, cost is so much more important. The ones who won initially tend to have slightly lower costs, meaning that it's a cost story. It's not that these guys were able to predict the bond market better than stock managers were able to predict the stock market. It's because they had a lower cost barrier. And it really, just like everything else in investing, there are certain things that you can control, and cost is one of the few actual observable concrete things. So once you can control for that, all of this story goes away. So that's kind of one of the big things. And, being able to tell those stories consistently really kind of, as Alex was talking about, really kind of cements in a lot of people's heads how it should be easy to do this. They're on CNBC. There's a new one every day, which means it's all over the place. So I can do it too.
Yeah, but this is where, there's a bit of a psych piece that comes into this. And I'll give you the example and then I can say the name. But everyone understands smoking is hazardous to your health, right? And every once in a while, somebody in your social circle will smoke and somebody will say, hey, not that they don't know this, but as a sign of concern, you say, hey, look, this is going to kill you. This is, you're putting your life in your own hands. And sometimes, at least maybe not now, but even 10 years ago, they would say, yeah, but my uncle smoked until he was 90 and he died of something else, so I'm good. That kind of thing. You're using the exception, the survivor, as the rule, right? And that's effectively survivorship bias. You're forgetting all the ones that did not survive. If all of a sudden, if you saw all the coin flippers that had to leave the stadium, you'd realize, you know what? Odds are I'm going to be like the 7,750 people that had to leave, that lost this game, not the 250 people that were lucky to win this game. Mm-hmm. You remember the winners, not the losers, which is the survivorship bias. You remember, but my neighbor across the street got this 10-bagger, and look at that. Trust me, for every one of those, there's 100 of the inverse story. They just don't like advertise it. And as much as your neighbor may have gotten a 10-bagger, he probably has, a couple of investments where he lost a shirt. He or she lost a shirt. They just don't advertise it. And so you remember the winners and you forget the losers quite often. And that the winners become more impactful because it's just a better story.
Absolutely. And, not only do you have to worry about, whether these managers have the skill to deliver on this type of stuff they're trying to deliver on that outperformance, you have to start wondering and worrying about how they're trying to do that. So one of the big things that people are looking at when they're evaluating manager performance is their performance relative to their stated benchmark. As a manager, you can go out and say, I'm running this fund. You should benchmark me against the Russell 2000. I'm a small cap manager. Benchmark me against the Russell 2000. Or, I'm a U.S. equity manager. Benchmark me against the S&P 500, whatever you want to do. You got to worry about them misspecifying that benchmark. You got to worry about them kind of defining their investment objectives incorrectly for the amount of risk that they're taking. And we already touched on this a little bit earlier on. You also got to worry about them changing through time with style drift. I don't think we've talked about that this much or all that much, but that's this idea that through time, the fund will change. The fund will not be in that same category or delivering the same risk experience that you were looking for initially.
I'm a little cynical to this as well, and there have been studies where you see. Again, returns usually come, not usually, I mean, you can almost like bet on it, but it comes relative to the risk that you're taking.
Yep.
And so some of that is random when those risks manifest themselves, when those returns happen to manifest themselves. But if you have enough funds out there, some will have timed it right, if not for just serendipitously timed it right. And so if all of a sudden small caps hit mid caps just go crazy, right? And I'm classified as a S&P 500 manager, I am going to look like Peter Lynch, right? And my assets go from, 50 million to 5 billion.
Yep.
To 50 billion, to whatever, some insane
number, yeah.
At that point, 5 years in, the dirty little secret is if you don't blow up that portfolio, people are not going to leave you. Like Kathy Woods with the ARK fund.
Yep.
If she would have kind of switched her positions and just followed the NASDAQ.
Yeah.
Her attrition rate for investors would not have been what it is now on an order of magnitude. And so what they do, these folks are making a living. It's a business. And so once they kind of hit it big, and a lot of these mutual fund companies put out like 12 feeder funds, 20 feeder funds, just to kind of see which one hits by luck. They close, which ones hit. Let's say 5 of those hit. Great. The 15 that didn't, they just shut them down. Right? And they keep those 5. Those 5 start aggregating assets because they get these Morningstar stars, right? And all of a sudden, 5 years in, they're managing an insane amount of money. They're in 401k plans. They just start tracking the index. Why? Because the returns will be fine. No one's going to be like, oh my goodness, something seismic happened here in the philosophy.
Yeah, no, there's
you had that inside baseball. Am I off on this?
No, it's entirely accurate. I mean, and you're absolutely right about those feeder funds. They'll basically create 100 funds, 100 probably exaggeration, but 20 funds, at any given time, feed them with a couple $100 million and let them run. And then after 3 years, when they've got that 3-year track record, they'll kill the ones that don't win. Once they, get to that point where people will say, oh, they've got a track record now, and start feeding money in, outside investors. There's a saying in personal finance, once you have it made, don't risk it. That very much applies to active managers as well. Once you have it made, once you have a good track record and people are going to be putting money in, don't risk it. And people will only pull money out once you start losing to the benchmark. So don't lose to the benchmark. Just get the benchmark. And you end up with a really, really expensive index fund at that point. So, that's absolutely that kind of third thing you want to be thinking about with regards to, how active managers are putting these portfolios together. But Alex, you had another point that I think is really, really important to think about as well. Let's say you do have that small cap fund. Let's say you are, that small cap manager who has had, one way or the other, you've had a really good 5-year period. And now you're on everyone's Morningstar screens and everyone wants to start putting money into your fund. That's awesome for you. But think about it from, even assuming that you actually have skill. You're the next Peter Lynch in the small cap space. How much of that can you actually put to work? You start getting, you're a small cap fund. You've now got $5 billion under investment. You've got $5 billion you need to invest. Is there $5 billion of investment space in these small cap companies that you think are good? Probably not. So you've got a choice. You can either, start investing in companies that you don't think are as good, that are not as good investment opportunities, which again, just means you're getting closer and closer to that closet indexer. Or you can start investing outside of your mandate. You can start investing in bigger companies who you think are pretty good. You can start investing in non-US companies, whatever it might happen to be, but not what people hired you to manage for. So you can either become a closet indexer by just investing in stuff that isn't quite as good, or you can start having some pretty substantial style drift. You can start investing in stuff that your investors aren't asking you to expose them to. So, this is one of those push and pulls. As the manager gets more and more successful, or at least they've gathered more and more assets, which for the manager, that's success because that's how they make their money. Almost invariably, that's going to lead to the fund not doing what got it to that point.
Bob, just because I don't know. I think it's a comfortable conversation, and we could probably do another hour on this because this is one of our real hobby horse here. But I'd like to, maybe my parting thought here is this. As much as we're talking about the failure of active management, and this is regardless if they're doing tactical or if they're doing market timing or they're doing fundamental. In God we trust, everyone else bring data. What do you find? Below suboptimal performance. The other comment that kind of is it's just stupid. When people say this, they know better. At this point, they know better. They're just, to me, again, this is just, they know better and they shouldn't be saying this. If you invest in index, you just get average returns. Mm-hmm. It's almost un-American of you to do that. What the heck are you thinking? And okay, not really. You don't get average returns because the reality is over the long term, what happens is, again, if these many people underperform in 1 year period, over a 3-year period, the probabilities go up that they'll underperform, or a 5-year period, the probabilities go up that you're going to underperform. So if you actually are an investor that's just capturing market returns, I'm not saying this stock is going to be better than that stock or any of that. I'm just capturing them all. I'm like harvesting returns, like a farmer in the field. I don't say this corn stock is going to be taller than this corn stalk, but it's going to produce more grain than this one across millions of corn stalks. I'm just going to harvest the whole thing, right? And that's what I'm going to capture. So if you do that from an investing standpoint over a 5-year period, you're actually going to outperform the majority of active managers. Not by a little bit, by a lot. I'm hesitant to say 80%, 70%, 85%, because I just don't know that number off the top of my head, but it's
Vast
in that
majority.
range.
Yeah.
It's a vast majority of it. And so for when you hear I don't want just average returns, I'm trying to keep this as a PG podcast way because I know that's your sensitivity, but it's not true. And these people know this at this point. And if they, at worst, they know this. At best, then they're just dumb. You want to be a bad person, or you just want to be a complete idiot, when you make statements like that. No, I don't know. It is what it is, man. So that's my response to that. Wait, Bob, am I wrong?
No, in fact, your choice of words there that it's indexing is un-American. I don't know if that was intentional or not, but that was literally one of the big things people would say when indexing was just starting to come out, that it was un-American not to try and be the best. And, indexing, emphatically is not trying to be the best in any given. It's not trying to pick the best stock. It's not trying to be the absolute winner in any particular year. It's just that consistent level of doing fine that ends up winning.
And un-American, this goes back to my comment in the last podcast. We batch these podcasts, so I don't know if it was so I'm going to stop the game where I say a week ago or a day ago, because I can't keep up. But it's actually totally American, because a 30-second pitch, if you're indexing, you're saying capital markets allocate capital efficiently. That's as American as it can get. And the only folks that think they're not allocated efficiently and they can engineer it by selecting prices that are off or whatever are the communists, right? No, at the end of the day, are people that want to engineer society. No, I know how capital should be allocated, and I'm going to try to do so, enforce it. Goes back to the price takers, price setters, that type of stuff in the last podcast. So I would say no, it's actually as American as apple. What was it about apple pie? So I'll end with that. Wade, however you want to, what are your parting thoughts? You heard from myself. You heard from Bob.
Baseball and hot dogs as well. But no, that's right. If you believe in capitalism, really, that's what an index fund is doing. Otherwise, you're a central planner who thinks one individual can better manage the economy.
Wow. I thought I was pretty strident on this one. I didn't ever come to the point that active managers are communists, but...
Hey, man, my mom already left Cuba and my parents left Cuba. I'm not going back. I'm done.
Yeah. Just start quoting Hayek at him, I guess. So.
No, I don't know it as well as you guys do, the philosophy behind it, but at the 40,000 feet level, it makes all the sense in the world. Mm-hmm. All right, and that's a wrap, guys.
Thanks, everyone, for listening.
Yeah, Bob.
We'll have to figure out what next week's episode is going to be about. We can't say, join us next time for such and such. But I think we are planning to bring in some additional outside folks who can help to really tell this.
Yeah, next week should be a really, really great one. There's some fun stuff coming up, taking a look at, how the financial media kind of plays into all of this, and really kind of diving into that and really taking a good look there. There's some interesting stuff. Hey, Bob, did you ever write cliffhangers for soap operas and stuff like that? I have because I think you should, because what did he say? Guys, next week, tune in. There's some interesting stuff. That's right. I'm I can't wait. I know. You've got talent, man. I know. I got to get into the new line of work here. So, all right, folks. We'll see you next week. Thanks for exactly. I don't know. Do people catch Wade's little intros when he is little throw-ins? They're awesome. All right, everyone. Bye.